Hi everyone. We'll move on to the second asset class in investment through mutual funds. Debt. It is against equity. Usually investors who are all more active and they need a high inflow of return as well as capital, they will not choose equity. So it is just opposite to the equity. It is good to the investor, those who are not much interested on continuous and so volatile income as well as capital appreciation. So debt is also the instrument where the investor is going to be invest in debt mutual fund. That means the company is going to be provide capital to the companies for the shorter period of time. That means for a fixed nature and for the fixed income. So that is called the debt instrument. Normally the return on debt, it is coming through interest income, and that interest income is fixed and it's also permanent till the end of the mature of that particular investment. It is safer than any other scheme, especially against equity. Why? Because normally in market there are two type of risk is associated with every investment, whether you're interested or not. One is interest, another one is capital. If I'm going to invest in particular asset, will I get the return or not? That is called interest. Second, will I get the capital or not? That's called capital risk or the credit risk. So both can be avoided if you keep your investment in debt. And most probably, while your investment go through any such a kind of avenues or any type of uh, what you call asset class, especially in debt are the sources. This debt can be invested by way of, that mean you can be keep your investment in bank deposit, a company fixed deposits, post office. These are all more or less debt. Post office deposits, uh, public provident fund, NSC National Savings Certificate, and debt mutual fund schemes. Among all, the safety is good in debt mutual fund schemes. Yes, it's do make the capital appreciation comparable to any other assets what you have discussed, that is called bank deposit, company fixed deposit, post office deposit, PPF. They will not give the capital appreciation. This debt mutual fund schemes will provide a capital appreciation. Why it is, how it is possible means this debt scheme will cover all type of risk is exposed in the market. If it is a price risk is there, it can be minimized through liquid funds. If it is credit risk is there, it can be reduced through gilt funds. If it is volatility risk mean, it can be minimized through FMB, that is fixed maturity plans. So all type of risk can be avoided if you go through with the mutual fund debt schemes, which means there are a lot number of debt schemes are available to cover all such a kind of the risk in market. That's the reason why it will give the capital appreciation. So why it is possible, that is the point number next, that is good against interest rate risk. This is a declining or maybe it is a increasing. If at all it is declining, uh, naturally what will happen mean we keep the associate with here the more number of capital asset in the case of debt instruments, so it will debt portfolio appreciate. This boosts the NAV and wealth of the investor in debt mutual fund schemes, through which they will get the capital appreciation. If it is in interest is increasing, that is also a floating rate schemes offer the protection against any significant decline in the value of the portfolio. It is good if you go through the investment by means of the SIP route, and especially it is more attractive because of totally the debt instruments are exempted from tax. And being a new investor, it is good but better get familiar with mutual fund by investing in lower credit risk associated debt schemes. When they are comfortable, they can switch to equity schemes to build their long-term wealth. So it is better and an appreciated way of investor investment. Can made in there the first time keep your investment debt instruments. Once you familiar with all the pluses and minuses in the debt instruments, then move your investment to equity and then earn good profit as well as create a wealthy portfolio for your future. Thank you.